So bear in mind, borrowing cost here, we are looking at the cost on a borrowed loan or a borrowed fund. If you have gone for a loan facility, the cost you incur on it. So bear in mind the cost here will be in relation to the interest on that loan facility, whether being the overdraft, whether being the short or the long-term loan. It could also be on some loan agreements may have some discounts and premiums on these loan facilities. These discounts and premium and any amortization cost in relation to it you have to consider. And also as any other cost in connection to borrowing, if you incur any other cost in connection to the borrowing, you have to consider that. In addition, if you are dealing with a lease or a concession and then you incur finance charges, it's also part of borrowing cost. And the last one here relates that if you have any foreign exchange differences arising from foreign borrowing, bear in mind generally foreign exchange gain or losses are not accounted for in the Ipsas 5. However, you only account for foreign exchange differences if it relates to a foreign loan. You have gone for a foreign loan, and then when you are doing the repayments, you have to pay the more than the amount you bargain for because of the exchange differences between the home country and then the your home country and that then the recipient country as well. So that's for borrowing costs. So this is to give you an enlightenment of the items that goes into borrowing costs. Now in public sector accounting, we have two approaches in accounting for borrowing costs. We have two main approaches. We have the benchmark treatment and then we have the allowed alternative treatment. So bear in mind we have benchmark treatment and the allowed alternative treatment. Now this is quite different from FR, those who are doing financial reporting. You might not have heard of benchmark treatment because it only pertains to public sector. So this is a little bit different from financial reporting. So why is it different? With the benchmark treatment, here the approach here is that all your borrowing costs, you are going to expense them. All borrowing costs, you have to expense them. Whether it relates to a qualifying asset, whether it does not relate to a qualifying asset, you have to expense them. That is if you are using the benchmark treatment. If you are using the allowed alternative treatment, and that's the same thing you do for FRIS 23. With the allowed alternative treatment, you only capitalize the borrowing cost that relates to the qualifying asset. So here we say that the borrowing costs that are directly attributable either to acquisition, construction, or production of the qualifying asset shall be capitalized. So that's the only one you capitalize as part of the cost of the asset. When we say capitalize here, it means you are going to add it as part of the cost of the asset, of the qualifying asset. Whereas if you have any other borrowing cost, you rather go what expense it. So bear in mind that with the benchmark approach, if you are using a benchmark treatment or approach, all the borrowing costs, whether it relates to the qualifying asset, it doesn't relate to the qualifying asset, you are expected to expense it. With the allowed alternative treatment, you only consider the borrowing cost that relates to the qualifying asset, then you add it to the cost of that qualifying asset. But the other borrowing cost that does not relate to the qualifying asset, you expense it. You expense it. Are we okay? So that's with the two methods that we have here. And notes for accounting policy's sake, when you choose a particular borrowing cost treatment or approach, you need to stick to it. So yeah, we say that there is a need for consistency in the treatment of the borrowing cost. So if you use a benchmark approach, stick to the benchmark approach. If you use the alternative treatment, you stick to it. So the method at which you pick, that's the one you stick to it. That's the one you stick to it. So that's with the two methods we have here. Now, diving deeper today, allowed alternative approach. With the allowed alternative approach, yeah, it depends on the type of borrowing cost you are dealing with. So we have two major types. So we have two kinds of borrowing cost. We have the specific borrowing cost, and then we have the general borrowing cost. So this is where the practical sense may start. So we'll start with the specific borrowing cost. So with the specific borrowing, when we say you have a specific borrowing, it means you have gone for funds, you have gone for an amount of money, or you have borrowed an amount of money specifically for that particular qualifying asset. And you are saying it may be for the position, it may be for the construction, or the production of the qualifying asset. So with specific borrowing, you have gone specifically for that loan for that particular qualifying asset. Example could be you want to build your dream house. So you went for a loan facility from the bank to build your dream house. So that is what a specific borrowing. Specific. Now let's dive into the calculation. So for specific borrowing, if you want to calculate for the borrowing cost, is going to be the actual. So this is the formula. It's going to be the actual borrowing cost you incurred minus any investment in. So the formula here is actual borrowing cost incurred minus the investment income. So what's the actual borrowing cost incurred? The actual borrowing cost incurred here is the borrowing cost that relates to the qualifying assets, the total borrowing cost that relates to the qualifying assets. And bear in mind, as entity, when we go for loan facility to do something, we don't use all the loans. We don't use all the loan amounts. We will begin with parts, and then parts will be invested. So the part that's invested, since that amount of money, the intention behind it was for that particular qualifying asset, and then you had an interest income on it. That interest income needs to be deducted from the interest expense so that we'll get to know the actual interest cost for that particular qualifying asset. So that's why we have this formula. That's why we have this formula. If there is a question at this point, the platform is opened. You can ask a question. Is there a question?
Success, I think we're okay.
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 If that's the case, then we'll zoom into the questions. So we'll start with our first question for the day. Can we get someone to read it for us? Anyone to read for us?
Okay. Um, question one.
Okay.
On first January 2011, Cape Coast Metropolitan borrowed 3 million at 20% interest per annum to finance the construction of a new office building, which was expected to take a year, 12 months to complete. Payments to the contractor were made as follows. Okay. Idle funds were invested temporarily during 2011, yielding an interest income of 100,000 Ghana cedis. Required. Calculate the borrowing cost to capitalize under Ipsas 5, assuming the Metropolitan adopts the alternative treatment of borrowing costs.
Okay. Thank you very
I'm
much.
done.
Okay. Thank you very much. So you can clearly see over here the method we are using. The last aspect says we are using the alternative treatment of the borrowing cost. So bear in mind that with As I said, with Ipsa 5, you need to specify which method you are using. Are you using the benchmark approach? Are you using the alternative treatment approach? So remember with the benchmark, we said with the benchmark, everything is going to be what? Expensed. But with the alternative treatment approach, that one you only consider the borrowing cost relating to your qualifying asset. Okay, in approaching questions relating to borrowing costs, the first thing you need to also identify, if you are using the alternative treatment approach, is to identify the type of borrowing. Is the borrowing specific or is it general? That's the first thing. It could be specific, it could be general, or it could be the two. So the first approach in answering the question is always to identify the type of borrowing. So in this question, what will be the type of borrowing? Is it specific or is it general? And what aspect of the question is telling you is specific or is general? Anyone? Yes, please. A hand is up. You can go ahead.
Yeah, so
It is
success.
Yes,
So
please.
you said that when it is specific, oh sorry, when it is specific, it means that we have a particular plan that we want to embark on. So here, you just wanted to build an office building. So the office building makes it specific for that loan. That's how I understand.
Okay, thank you very much. Okay, so as you clearly see over here, they said the CC, a hand is up. Okay, you can go ahead. I want to avoid mentioning the names because we are recording the session. So a hand is up. Yeah, you can go ahead. Okay, so let's proceed. So yeah, you could see that it says CCMA borrowed the 3 million at 20% interest to finance. So the purpose, they brought the purpose over here. The main reason why you went for the loan was to finance the construction of what? A new office building. So that made it what? A specific loan or a specific borrowing. So now once we know that we are dealing with specific borrowing, the next thing is for you to know the formula. Remember we said with specific borrowing, the formula is going to be your actual borrowing cost incurred, and then you less your investment income. So yeah, we have to first calculate for an actual interest incurred, our actual borrowing cost incurred. So let's do that one in the Excel sheet over here. So we said borrowing costs. In this case, will be the actual. So we have to bring our actual borrowing costs. So let's calculate for our actual borrowing cost. Over here, to get the actual borrowing cost, we have to pick the percentage. So the percentage we used for the interest here is 20%. So we'll pick the percentage of interest, which is 20% over here. So it will be 20% times the loan amount. The loan amount we went for, which was 3 million over here. We bring the 3 million. Then you have to consider the period involved. So sometimes you might not borrow at the beginning of the year. So the period here involved was 1st January 2011, meaning that the amount of money will elapse from 1st January to 31st December. Because the requirement is that we need to account for the borrowing costs up to the end of the financial period, which we are assuming to be 31st December in this case. So yeah, it's 12 months. Once it's 12 months, we don't worry ourselves with the number of months. So we calculate that to give us our actual borrowing cost incurred. So can someone calculate for us? 20% on 3 million. What we get?
Six hundred
Six hundred
thousand.
thousand.
Okay, 600,000. Thank you very much. Then the next thing we need to do is to less our investment income. So, what was your investment income in the question? Yeah, can you please mute yourself? So the investment income here is 100,000. So bring that's the investment income, which is 100,000. So we'll less that to give us that
500,000.
is 500,000.
500,000.
Okay, thank you. So that will give us 500,000. So that will be the borrowing costs for the qualifying assets in our instance. So let's check the requirements if that was all that the question asked. So the question said we should calculate for the borrowing cost to capitalize under Ipsas 5. So yeah, it was just the borrowing cost that the question wanted us to calculate for. If the question went on to say we should find the cost of the qualifying asset, cost of the qualifying asset. If you are looking for the cost of the qualifying asset, it will be the specific borrowing amounts plus the borrowing cost to capitalize. So in our case, the cost here will be the 3 million. 3 million was the specific amount
Yes, please.
plus the borrowing cost, which is
500,000.
500,000. So that will give us a totality of 3
3 million
million
500,000.
500,000. Okay, so that will be the answer if the question asks us to calculate for the cost of the qualifying assets. So this is for question one. Is there any question on this? Like something you don't understand, like me to throw more light on. Okay, if there is none, then let's go to question two. Are you there? Is Arida around?
Yes, I'm here.
Okay, kindly proceed.
Okay, question two. On 1st January 2010, a public university, University of Aposika, borrowed 30 million to finance the building of two students' hostels, both of which were expected to take a year to complete. Construction started during 2009. The loan facility was drawn down on 1st January 2009 and was utilized as follows with the remaining funds utilized invested temporarily. The loan interest rate was 30% per annum and ABC would invest surplus funds at 20% per annum. Required. Ignoring compound interest, calculate the borrowing cost which may be capitalized for each of the buildings. If the public university applies the policy of capitalizing borrowing costs under Ipsas 5 and consequently the costs of each of the buildings as at 31st December 2010.
Thank you very much, Arida. So remember the first thing you have to do. First, you have to know the approach you are using. Are you using the benchmark approach? Or are you using the alternative approach? Which approach applies to this question? Anyone? From the
The
requirements, which
alternative,
approach do you think we are using?
the alternative treatment.
The alternative treatment. That's true. Because remember, it's the alternative treatment that allows you to capitalize the borrowing cost, which was also said at the requirements. So since you are capitalizing the borrowing cost, the next thing you're supposed to ask yourself is, are we dealing with specific borrowing or general borrowing?
Specific borrowing.
Specific borrowing.
Yes,
Why is
please.
it specific borrowing? Yeah, they said to finance the building of what? Two
Student
student
hostels.
hostels. So you borrowed this amount of money to finance that construction of the building of the two student hostels. So how do we go about it? You remember the formula? It will be
Yes,
the
please.
actual
Borrowing
borrowing cost incurred minus your
minus investment
investment
income.
income. So let's do that for this one as well. So yeah, we have it in two. We have building one, building two. So let me bring that building one and then building two. So first things first, we need to find our actual borrowing cost incurred. So how are you going to do that? So yeah, since the amount of money has been separated for building one and building two, you have to also deal with that separately. So let's add. Building one is we took out 5 million on 1st January 2010, and we took out the remaining 5 million on 1st July 2010. So that will give us a total amount of 10 million, right? So that will be 10 million. Then with building two, it was 10 million at the 1st January and another 10 million at 1st July. So that will be
20
20
million.
million. So you can see that all is summing up to give you your
30
30
million.
million. All is summing up to give us our 30 million. So that should tell you that all the amount of money was used for to finance the two facilities, the building one and building two. With this question, we have two approaches to go by. And to establish understanding, I'll go by just one of the approach because I see that's much easier. So with this approach, to get the actual borrowing costs incurred, let's start with each of the loan. On 1st January 2010, we take 5 million. We use 5 million as the loan facility. So to get that one, the loan facility will be from 1st January to the end of the year, which will be 31st December. So that will be the period for the first amount, which is the 10 million, the 5 million, sorry. So we'll calculate for the interest that relates to that. So that will be 30% on the 5 million. So that will be 30% on the 5 million. And yeah, the number of months is 12 months, so we don't have any worries with that. Let's calculate
So
for that.
that would be 1,500,000.
So 1,500,000. We'll do the same for, so this one is for building one. So B1. Let's do that for building two.
Okay. So building two will be 3 million.
So that will be 30% times the 10 million. Building two was 10 million in the question. So that will give us 3 million, right?
Yes, please.
Then we'll go to the second amount, the period. It was from 1st July 2010. So we'll start from,
October, November, December.
so it will start from when? It will start from 1st July. The interest. The interest will accrue from 1st July up
Yes.
to 31st December. That will be how many months?
6 months.
6 months.
July.
So building one. We'll do that for building one. Building 1, the amount is still 5 million over here. So it will be 30%, the interest percentage times the 5 million. We multiply by the number of months involved. So the number of months in this case is
6
6 over
months.
12, right? 6 over
Yes,
12.
yes, please.
So what will you get?
750,000.
750,000. Then we'll do that for building 2. We'll also multiply that one by 6 on 12.
1,500,000.
1,500,000.
500,000.
Okay. Then we sum the two together.
Building 2,
Yeah.
4,500,000.
And then what about building 1?
Okay. That will be 2,250,000.
2,250,000.
50,000.
Okay. Then we come to the interest income. So we less the investment income in this case. So investment income over here we're given a percentage, 20%.
8%. Yes, please.
Yeah. So bear in mind we 20% is the surplus funds. So you invest only the surplus fund. So we establish at the initial that's building 1. Total amount for building 1 is what? 10 million.
Yes, please.
But bear in mind, out of the 10 million, we only use 5 million on fair genuine.
Yes.
We only use 5 million on fair genuine, meaning that the amount of money will be idle. An additional amount of money will be idle from fair
For
genuine to
six
when
months.
the next payment.
Yes.
So in that case, the period at which we will have the idle fund will be from fair January. It appears I'm getting a feedback. Can you please mute yourself if you're not muted? Okay, thank you. So that will be from 1st January to when the next payment was made, which is 1st July. So we can say it will be lying idle from 1st January to 30th June. 30th June. So if you realize here, the 5 million years from 1st January 2010 till 30th June 2010 because the next payment was made in 1st July of 2010. So the idle fund, 5 million will be lying idle from that period. So in that instant, we'll calculate for. So bear in mind, here is 6 months. Let me bring the months. 6 months over here. So for building 1 is going to be 20% on the amount of money which will be lying idle, which is 5 million. Then we multiply by the number of months involved, which will be 6 over 12.
So
What are you
it will
going to
be
get?
yeah, it will be 1,250,000.
1,250,000. Then we come to building 2. Building 2 will be 20% of the idle fund. So let's check the idle fund. So building 2 to the total amount for building 2 over here was the 20 million. 10 million plus 10 million will be 20 million. That means that we only use a portion on 1st January, meaning that the remainder 10 million was lying idle to when you used it. And then we used it on 1st July, meaning it was lying idle from 1st January to 30th June. So that will be also 6 months over here. And the idle amount is 10 million in this case. Then multiply by 6 on 12.
That will give us 1 million.
That will
One
give us
million.
1 million. Okay. Then when we are done with less them to give us the borrowing cost, the borrowing cost to capitalize.
Hello, please. The investment income. The figure there is wrong.
The figure is wrong.
It's supposed to be 500,000.
What are you going to get?
500,000.
500,000. Okay,
Like
500,000.
500,000.
So we less. When we less, what do you get?
One million 750,000 for building one.
We less. So it will be
1,750,000 for building one.
1,750,000 for building
Building
one.
2,
Building two will be
3,500,000.
3,500,000. Okay. Okay. So that will be the borrowing cost to capitalize. That's the first aspect of the question. The question told us to calculate for the borrowing cost in which you are going to capitalize. Then the next one, they say we should find for the cost of each of the building. Cost of each of the building. So if you're looking for the cost of a building, we'll first pick the borrowing cost to capitalize. Then we'll add the loan, the specific borrowing amount, specific borrowing amount. So for building one, the amount we saw that the first one, the building one, the two amounts gave us 10 million. So we pick the 10 million. And for building two, it was 20 million, right?
Yes, please.
So we sum the two together.
That will give us 30 million.
So here to give us 11,750,
Okay.
and here we get
23
20
million
million.
500.
So that will be the cost of the qualifying assets. So the cost of the qualifying assets. So any question on question two?
Yes, I mean,
Yes, please.
yeah, please, I want to ask that, please, when we are done with the class, please, can you kindly put the notes and the questions on the page for us?
Noted. I'll do that.
Please come again.
I said I'll do that.
Okay, okay. Thank you. God bless you.
Amen. So any question on question two? Yeah, hand is up. Go ahead. The hand is up.
Yeah,
Go ahead. Yeah.
please. Yeah, please. Can you hear me?
Yeah, I can hear you.
Okay, please. I think with when we were calculating the borrowing cost, I thought that we made some divisions. That's for first January and then July.
Yes, please.
But the amount that was borrowed, so we said they borrowed it at from the beginning. That is 30,000 on first January. I wanted to ask that if the interest or the cost on that money that we borrowed will be divided according to how they were used in the business. Where they made payments into the business on first January and then July, but the whole amount was
Yeah.
taken in January. So I wanted to know if we pay the amount according to January or we make divisions with regards to payment of the interest, like how it has been done now.
Okay. That's a good question. So yeah, the reason why we divided here was because number one, the loan facility was for two different hostels, building one and building two. It wasn't combined. If it was combined, I will agree with you. We can just assume from the first January and then we deal with that. But because it has been separated, we have to deal with the separation separately. And then when it also came to the payment, we did it that way separately. I fine.
Yeah, yes, please, but a bit confused. I was thinking that maybe because you knowing that the amount for 10,000 and then that's for building two was 20,000. I was thinking we calculate the interest, the borrowing cost on the 10,000 for building one and then the 20,000 for building two. That's for the 12 months. But I don't know, a bit confused.
Yeah, that's another suggested solution for this question too. So yeah, I've seen that solution as well.
Okay, please, thank you very much.
You're welcome. A hand was also up. Is the hand up? Okay. And since we are done with that, we'll go straight into general borrowings. General borrowings. So with general borrowings is when the you didn't go for that specific loan for that particular qualifying asset. You know, as a firm or an entity, we may have several loan facilities. And then if we want to undertake a project and then we realize that we don't have the needed funds, we just pick the amount of money from our pool of debt or from the numerous loan facilities we have. So in the case whereby the qualifying asset was financed from your pool of debt, from your general facility of loans, then that one you have to use, it means it falls under general borrowing. So yeah, general borrowings here by definition here is the other borrowings that could have been repaid if the expenditure on the qualifying asset had not been incurred. So they are the other borrowings that you used in financing your qualifying asset. And when it comes to general borrowings, the first thing you need to ascertain is the capitalization rate. If you check the standard cost is the weighted average rate. So you need to get the weighted average rate or the capitalization rate. Reason being that the loan facilities or the loan facility does not emanate from just one loan. It's not from one loan, but it's from different loans. It's from different loans. And since it's from different loans, you are expected to get one rate that you're going to use to do your capitalization. And how do we get a rate? So mathematically, to get a rate, you just have to pick the total interest. Then you divide by the total loan. You multiply by 100, and that gives you the capitalization rate. Then when you get the capitalization rate, to get your borrowing cost now will be the capitalization rate you have gotten multiply by the pool fund you use. Bear in mind the key word is you used. You may be having a pool fund, but you may not use all for the qualifying asset. You only consider the one that you use for the qualifying asset. Are we fine? So bear in mind with general borrowing,
We
first things first, identify the capitalization rate, which is the total interest over total loan times 100. Then you multiply the capitalization rate by the amount that you took from the pool of fund to finance the qualifying asset. That's all for borrowing cost under general borrowing. Is there a question? Something you don't understand you want me to explain further? Okay. One thing I want you to note over here is that when you're calculating the capitalization rate, you should not include specific borrowing in your computation. So I'm repeating it again. Whenever you're calculating for the capitalization rate for general borrowing, don't include specific borrowing in your computation. There are some questions you may be given specific and general together in one question. In that instance, you need to solve for them separately. In solving for them separately, when you're calculating for the capitalization rate for the general borrowing aspect, make sure you don't consider anything specific in that computation. So that's the key thing I want you to note for that. Any question? Okay, then let's go to our questions then. Arida, kindly read for us. Arida, are you there?
guys, but
Or maybe it's bored. Let's get some another person should read for us. Yes.
MMDA has the following source of borrowing: 7-year-old loan, 800,000, interest 100,000; 25-year-old loan, 1,200,000, interest 100,000; bank overdraft 400,000, interest 60,000. Required: assuming MMDA adapts the alternative treatment of borrowing cost. A. Calculate the capitalization rate if all of the borrowings are used to finance the production of qualified assets, but none of the borrowings relate to a specific qualifying asset. B. If the 7-year loan is an amount which can be specifically identified with a qualified asset, the rate which should be used on the other assets.
Okay, thank you very much. So yeah, they want us to only calculate for capitalization rate. So this question, the intent is to help you to know the calculation of capitalization rate. So let's dive into the solution. So first things first, you have to know the formula for capitalization rate. And if you remember, we said the formula for capitalization rate will be total interest divisible by your total loans. Then you multiply your answer by what? 100. So let's start with that. Let's look for the total interest in our case. Yeah, it was calculated for us. So the total interest we have 100,000 for the first one, 100,000 for the second one, the last one is 60,000. So when we add them together, 100,000 plus 100,000 plus 60,000. So that will give us
So let's take out
260,000. Then we look for the total loan as well, which will be 800,000 1,200,000 and 400,000. So 800,000, 1,200,000, and I think the last one was 400,000. Let me check. Yeah.
So 400,000.
So let's sum it up. That would be
400,000.
2,400,000. Then now we calculate for capitalization rate. So that would be 260,000 divisible by 2,400,000.
10 points.
Then multiply by 100. What do we get?
10.833.
10.8%.
10.833.
833.
Okay, so two decimal place, 83%.
Okay.
So that would be our answer for that. Then we come to the B. So the B here says that if the 7-year loan is an amount which can be specifically identified with the qualifying asset, we should look for the rate which should be used on the other asset. So the main intention of the B aspect is to tell you that if you have a specific loan, you shouldn't consider it when you're calculating for the capitalization rate. So the B here is telling us that we are announcing B is a specific loan. So if B is a specific loan, meaning that if you are calculating for the capitalization rate, you are only going to consider only the 25-year loan and then the bank overdraft. These are the only ones we'll consider. We are not going to consider the 7-year-old loan. So yeah, a hand is up.
Please, can you go?
Hello, yeah. Can you repeat
Please,
what
can
you
you
said?
repeat what you said?
Okay, so I was saying that yeah, the B was saying that if the 7-year loan is an amount which can be specifically identified with a qualifying asset, this statement implies that the 7-year loan is a specific it's a specific loan. And then we said over here that when you're calculating for your capitalization rate, you shouldn't bring anything that relates to specific borrowing. So when you're calculating for capitalization rate, don't bring anything in relation to specific borrowing. So in that sense, it means that if you are calculating for the capitalization rate for B, we should only consider the 25-year-old loan and then the bank overdraft. So when we come here, calculating for the capitalization rate to get a total interest now, so that will be the B. So the B aspect, calculating for the total interest, we are going to ignore the first 100. That's one for the one for the 7-year loan. So now we'll have a total interest of 160,000. Now when it comes to the total loans, we are going to ignore that of the first one as well, which was for the 7-year loan. It's just going to be the 1.2 million and the 400,000, and that will give us 1,600,000. Then to get our capitalization rate, let me just pick this and edit. It will be the 160 divisible by 1,600,000. So that will give us 10% off.
Yes, please.
So we'll get
10%.
10%.
Yes, please.
So that's that for question one. Any question on that? So the focus of
Please,
question one is focus
please,
of
if you
question one.
can re-explain the B part, please.
The B part.
Yes, please.
Is it the calculation?
Yes, please.
So the B part, the question said that 7 year loan is a specific borrowing. We can treat it to a particular qualifying asset. That makes it specific borrowing. So if that's the case, meaning that we are going to ignore 7 year loan and only consider the 25-year loan, that of the bank overdraft. So what we did here was to the total interest. We only brought that of the second loan and then the bank overdraft, and that gave us 160 over here. Then with the total loans too, we ignored the 7 year loan. So we brought the 1.2 million, which was the second one, and the bank overdraft, which was the 400,000, giving us 1.6
Um,
million. Are you okay now?
yes, please.
Okay. Let's go
Thank
to the
you.
next one.
So, sir,
Yeah.
Yeah.
Senior Sammy.
Yes, please.
Senior
so
Sammy.
it means that,
Yeah. One by one. One by
sorry,
one.
sorry.
One by one. Let's take our time. Yes. So go ahead. The ones someone has raising the sum. Go ahead. Let me start with you.
Yeah. Yeah. Senior Sammy, please. It's Isaac. Please, I was asking that. So with the question one and with the requirement B, if the question has asked us to base on the requirement B to compute for the borrowing cost, then it means that does it mean we are going to use the 10% to multiply um the pool of the funds excluding the 7 year loan which is 800 Ghana cedis,
So are you talking?
800,000.
You are talking from the B, right?
Yes.
Requirement B or requirement A?
Um the requirement B, okay.
Okay. Initially it said A. That's what
Assuming
bothered
that,
me. So
yeah,
if
assuming
it's
that,
for the requirement B, then yeah, you're right.
yeah.
Then you're going to use a 10% to calculate on the borrowing cost, the loan that we use for the qualifying asset. So
Oh,
yes,
okay.
you use the
Okay.
10%.
Okay, thank you.
Okay. So the second person, continue, please. Your question. Is there a question?
Okay, okay, it wasn't really, it's no different from the first one. So what I wanted to say was that suppose the B came before the A. Yes, that was the only question there. Were we going to ignore the 7 year loan in the calculation of the capitalization rate?
Exactly. You're going to ignore it.
Okay, thank you.
You're welcome. Okay, let's go to question number two. Quite a lot. So yeah, someone should read for us.
On on 1st January 2018, MMDA commenced the construction of a new factory. The following payments were made during
On
2018.
2018.
Okay. 31st January, 200,000. 31st March, 450,000. 30th June, 100,000. 31st October, 200,000. 30th November. Okay. The first payment on 31st January was funded from the entity's pool of debt. However, the entity succeeded in raising a medium-term loan for an amount of 800,000 at 31st March 2018 with a simple interest of 9% per annum, payable in arrears monthly. These funds were specifically used for this construction. Excess funds were temporarily invested at 6% per annum monthly in arrears payable in cash. An amount of 200,000 from the pool of debt was used for the payment on 30th November, which could not be funded from the medium term loan. The construction project was temporarily halted for 3 weeks in May due to substantial technical and administrative work being carried out. The following amounts were outstanding as at 31st December 2018. Medium term loan, details above, 800,000. Bank overdraft, brackets, total interest for the year 33,800. 10% 7-year loan. The amount is 750,000. Okay, sorry, 10% 7-year loan issued, that's 1st of October 2017. Simple interest at 31st December, 9 million. Required, assuming MMDA adapts the alternative treatment of borrowing cost. A. Calculate the capitalization rate to be applied to the pool debt. B. Calculate the amount of borrowing cost to be capitalized and the carrying amount of the new factory. Thank you.
Okay, thank you very much. So, with this question, the first thing was for us to know the approach, and here we clearly see the approach here. We are using the alternative treatment approach. And then once you are using the alternative treatment approach, the next thing you should ask yourself is, are we dealing with specific borrowing or general borrowing? Remember, that's the first step. Once you identify the approach to be alternative. So are we using specific or it is general? Is it specific borrowing or general borrowing?
So that I think is the two.
And then two, why do you think is the two?
For one, these funds were specifically used for this construction. Excess funds were temporarily invested at 6% per annum monthly in arrears, payable in cash. So it means that the cash which were borrowed were specifically used for the construction of the MMD's new factory. Yes, that makes it specific.
Specific. What about the general?
Yes. For the general one, you said that these were, let's say, loans that could have been avoided if the decisions were not made. And in the latter part of the question, it says that it stated something about it could the people couldn't uh, finance that loan from their normal source of loan, so they have to go into their pool of loans to finance those projects. So an amount of 200,000 from the pool of debt was used for the payments on 30th November, which could not be funded from the medium term loan. So that makes
Okay.
it like a
Okay, the explanation. It seems you are partly right, partly wrong. You are right that by saying that it's both specific and general. But your explanation on the specific one, I wasn't really satisfied. You said all the loan, you were not specific on it. So which one is the specific borrowing in this instance? It was a medium term loan. Yeah, it says, however, the first thing it says here was that the first payment, which is the one on 31st July, was funded from the entity's pool of debt. So that should tell you that this amount of money is from the entity's pool of debt. Then he went on to say, however, the entity succeeded in raising a medium-term loan for an amount of 800,000 at 31st March 2018 with a simple interest of this in arrears. And it went on. So these funds are referring to what? The medium-term loan. Are you okay?
800,000.
So that was the only thing you left out. Apart from that, everything you said is correct. Correct. Okay, so that's good. So you should know that this question is both specific and general. And remember, I told you that if you have both specific and general, you should separate the computation. You calculate for borrowing cost separately for specific borrowing. They calculate for borrowing costs separately for general borrowing. When you are done, then you add the two together. Are you okay?
Yes, boss.
So when it comes to this, let's go by our requirement so that we don't deviate. The requirement A is saying that we should calculate for the capitalization rate. And you should know that we only calculate for capitalization rate when we are dealing with what general borrowing. So A is telling us to calculate for capitalization rate that we use for the general borrowing. So we'll come here, first things first, you bring your formula. So that was question 2, yeah. So first things first, we bring the formula. Then we calculate for total interest, which will be, so in our instance, total interest, are we going to consider the medium term loan?
No, no, we are not going to consider it
Why?
No, no.
because that is a specific loan.
Yes, that's a specific loan. It said details as above. So details as above, we identified that the medium term loan over here was what specifically used for the construction. Meaning that that one is what specific loan. So I mean I will only
no.
you mean that to calculate for the capitalization rate, it's only going to be the bank overdraft and then the 10% year loan that we are going to consider. So the interest here will be for the bank overdraft, we have been given the interest here, right? Okay, this is the interest here. So say total interest for the year is 33,800. So we bring that one 33,800 plus we calculate for the interest for the 7 year loan, which they gave us a percentage to be 10%. So it is going to be 10% multiplied by the amount, which is what 9 million over here. So 9 million. And so let's calculate for that. When we add the two,
We are getting 933,800.
933,
33,800.
800. Okay. Then we calculate for total loan. Please ask if someone is mentioning, someone will also cross check if you are right, so that we don't have to come back again. So yeah, we'll pick the bank. I'm not saying you are wrong. Okay,
Yeah, I
so
understand. I understand.
we'll pick the bank overdraft, which is the 750, and then we'll add the 7 year loan. So 750. Then we add the 9 million. So this will clearly give us 9,750,000.
750. Someone should also check.
So calculate for the capitalization rate. Let's calculate for capitalization rate. That will be the total interest, which is the 933,800 divisible by the 9,750,000 times 100. That will give us
We are having 9.58%.
9.58%. So that will be for the A aspect of the question. The A. And when we come to the B, the question, when we come to the question 2B, we were told that B calculate for the amount of borrowing costs. So remember in this question we have specific and then general. We have specific and that of general. So we can. Which one should we do first? Which one should we do first? Let's do the
Let's
specific.
go with the specific. Oh,
So let's start with the specific. So remember the formula for specific borrowing. Do you remember?
yes, sir.
Okay. Anyone to help us? Just as recap.
Isaac.
Don't mention anyone's name.
That's actual borrowings minus the investment.
Okay, so actual borrowing cost minus the investment
Yes.
income. So we bring the actual borrowing cost in this case. How do we get the actual borrowing cost? So we have to go to the question. We have to find the ones which are the specific borrowing. So bear in mind the specific borrowing, we're giving the amount as 800,000, right? Bear in mind the amount is starting on 31st March 2018. That means that it will be from 31st March to 31st December, right?
Yes,
So
please.
the specific borrowing also comes with a percentage on its own. So that one is 9%. That's for the specific borrowing. That was 9%. So we bring the 9%, you multiply by the loan amount, which was the medium term loan was 800,000, right?
Yes.
Over here, it was 800,000. That was for the medium term loan. So multiply by 800,000. And then what was the number of months in this case? For the specific?
So
9 months.
9 months. 9 months. So meaning that we multiply by 9 over 12. Oh, what are you going to get?
54,000.
We'll get 4,000.
54,000.
54. 54,000. Okay, then we come to the investment income. So with the investment income, let me bring this one here. So with the investment income, how do we go about it? Remember we said the investment income, you first have to find the rate given to you in the question that you're going to use to invest. Then you look at the idle fund. So you have to ask yourself, were you giving, you look for the idle fund, and the idle fund here will be based on the period involved. So you look at the period in which the amount of money became idle. So in our question here, they were told over here that excess funds were temporarily invested at what? 6%.
6%.
So this is the percentage you are going to use. However, let's find for the idle fund. So we'll go to the chart of payment. You can see a payment schedule over here. Now the question clearly told us that this one, the question said it's here. Let me repeat it again so that they said the first payment on 31st January was funded from the empty pool of debt. Pool of debt here means that it was general borrowing. So they said the first payment. This first payment here is general borrowing. This first payment is general borrowing. Are you fine? And then
Yes.
yeah, so it went on to say that, however, the entity succeeded in raising a medium-term loan for an amount of 800,000 at 31st March 2018. So meaning that the medium-term loan, we started using it on 31st March 2018. So out of this 800,000, how much did we use at 31st March? We only used 450,000, right?
Yes, please.
Yeah, so over here, if you want to get the surplus fund, In case you want to get a surplus,
Yes.
the surplus fund. If you want to get a surplus fund, how much will be the surplus fund at this date?
So
Surplus
it's
fund.
going to be 350,000.
350. How did you get a 350,000?
Less than 450,000 from the 800,000.
So you picked the total, which was 800,000, then less from the 450,000. That's what gave us the 300 and what? 50, right?
50,000.
350,000. So bear in mind that this is the amount of money which was lying idle on 31st March. This amount of money will lie idle from 31st March up to when the next payment will be made. So when was the next payment made? Which date was the next payment made? 30th June. That means that the
June.
350,000 was lying idle from 31st March to which date?
Up to
June.
June, 30th June.
30th June. It will be before June. Okay, let me still use the 30th
Yes.
June. So it will be before June. So let
Yes.
me do it 30th, 31st March. It will be 31st March to a second.
So
31st.
it's like 1st April to 30th June.
Someone can do it 1st April, someone can do it 31st March. Anyway, to when?
30th June.
30th June.
To 30th June. So how many months is that?
Right.
How many months?
3 months.
3 months. So 3 months. So we calculate for the interest in that regard. So we pick the surplus percentage, which is what 6%. Then we multiply by the idle amount. How do we get the idle amount? We pick the total loan facility for the medium term, and then we'll subtract it from the 450. The first payment was 450. And then we multiply by the number of months, which is what? 3 over 12.
3 months.
What do we get?
I get it
Six
5250.
thousand. Hey,
Calculate.
6,750.
Please calculate for us clearly.
I think he's right.
What did we get? What's the answer?
5250.
5
Five
5250.
250.
5250. Like this.
Yes,
Yes,
please.
please.
Okay. Then we continue again. The next one. So it means that yeah, 350 was lying idle. Then when we came to 30th June, we used 100,000. So the surplus money here will be what will be the surplus over here?
700.
250.
250. How do we get a 250?
Surplus after 450 minus the 100,000.
Yes. So the surplus that we have, which was the 350, minus the 100,000 we used on 30th June. So we move on to the next one. That will be from 30th June to when the next payment was made. So the next payment was made
October.
31st October.
October.
31st October. How many months is that?
Or months.
How many months?
4 months. 4 months.
4 months. So 4 months. So we'll do that 6% by This time around, we have the idle fund, the 800,000 minus 450 gave us the 350, right?
Yes.
Minus the 100,000.
100.
So the surplus fund we had,
100,000.
yeah. So the surplus fund we had there was the 250. So if we pick the 350 minus the 100,000, that was how we had the 250. I'm doing this just to show workings, because if you are asked to present, you have to show these ones as well. You don't assume.
5,000.
So we multiply by the number of months, which is 4 over 12. What do we get?
5,000.
5,000.
5,000.
5,000. Then proceed to the next one. So when we came to 31st March, we used 200,000. So what's the surplus fund in this case?
So we have 250.
50,000.
So it will be left with 50,000.
50,000.
So let's do that part. So that will be from
That is
31st March, 31st October, sorry, to when the next payment was made. The next payment was made when? 30th November, right?
20 November. Yes.
October,
30th
November.
November. How many months would that be?
One.
How many months would
one
that
month.
be?
1 month.
1.
1 month. So that will be 6% times the 250,000 that we had over there minus the payment was 200,000, right? So times 1 over 12,
3,000.
3,000. Okay, then we move on to the next one. So the next one is 50,000. Then we came to 30th November, we used 250,000. So what's the surplus fund left over here?
So it will be, we are going to owe 200,000.
You are going to owe, I like that part. You are going to owe
So
200,000. So bear in mind that on 30th November, the surplus fund, nothing was left for
yes.
surplus fund from the medium term loan. We don't have any amount of money from the medium term loan because we used all and then we are even owing additional what 200,000. So the additional 200,000 was what we were given information over here. We're told that yeah, an amount of 200,000 from the pool of debt was used for the payment on 30th November, which could not be funded from the medium term loan. So the additional 200 on 30th November here was from the pool of debt. That's general borrowing. So that should tell you that over here, 50,000 here is specific. So yeah, 50,000 is specific. And then the remainder 200,000 here is what? General.
General.
So the general borrowings in this questions are two. I hope you have seen that.
Yes, please.
General borrowings in this question there are two. The one on the 31st January and then one on 30th November. So in that case, at the end we don't have any amount of money for investment. The
Hello.
sum, yes, please. Go ahead.
The last figure is 250. 250.
200, yeah. The
Yes.
30th October to 30th November. The
Yes.
answer will be 250.
Yes.
Is another person to confirm?
No, no, it's supposed to be zero.
Supposed to be zero.
Yes.
Please mute yourself. Please mute yourself. Uh-huh. Someone should confirm. Someone should confirm. The last one.
Yeah, it's 250.
250.
Yes, please.
Then let's sum it up.
So in all, it will be 10,500.
10,500.
10,500.
500.
So we have to less this 10,500
Yes, yes.
from the actual borrowing cost. So let's less that.
43,500.
Okay.
43,500.
500.
So this will be the borrowing cost to capitalize from the specific borrowing. So this is the borrowing cost to capitalize. Any question on that?
Silence.
Yeah.
I'm sorry for giving that zero answer. I thought we were talking about the 30th November school.
Don't
I
worry,
thought
don't
you were
worry.
asking about the investment.
Okay, don't
Sorry.
worry. Okay, so if you're done with the specific, let's go to the general borrowing. So with the general borrowing, remember the formula to get a borrowing cost to capitalize. We said we will bring the capitalization rate, and then we'll multiply it by the pool fund used for the qualifying asset. So let's do that here. So let's first bring bear in mind that general borrowing were two. We had one on 31st January, and we had one on 30th November. So let's do for the first one. The first one will be from 31st January till the end of the year. That will be to 31st December. So how many months would that be?
12.
11 months,
12 months.
11 months,
12,
or
11. 11.
if 31st January, accounting students, date
11
is very,
months.
very important to us. Accounting date are very, very important to us. So you can see 31st January, meaning that January is not part. Okay, so yeah, we'll bring the capitalization. We have already calculated for the capitalization rate. Do you remember? That was the A. We had 9.58. So we'll bring that one here. 9.58%. And then we multiply by the pool fund we use. So the pool fund we used at that date was for 200,000. So multiply by 200,000. Then we consider the month, which is 11 divisible by 12. That will give us
17,500.
0.33.
563.33.
0.33.
Okay. Then move on to the second one. The second amount was on 30th November. So that one will be from 30th November to 31st December. How many months is that?
1 month.
1 month. So that will be 9.58% times the amount of money was 200,000. Do you remember?
Yes.
Yeah, we established that it was 200,000 from the question. The question made us aware over here. The amount of 200,000 from the pool of debts. So we saw that use 250 is 50,000 for specific, and then the remainder 200 was for the general. So let's calculate for that. We multiply by 1 over 12. Don't forget.
1,596.66.
Yeah, please come again. Say 1,000 what?
596.67.
So it will be 6,7. Okay. Then we sum the two up. So that will give us this answer. And then we are done. So this is the borrowing cost from the general borrowing. When you're done, you now start to look for the total borrowing cost. And what will be the total borrowing cost? It will be the specific borrowing, its borrowing cost plus the general borrowing, its borrowing cost. So that will be the 43,500 that we have for the first one. Then we add the 19,150. That will give us
2,660. 1,660.
52,650. Yeah, so this will be the total borrowing cost to capitalize. So that was the question. Total borrowing cost to capitalize over here. And then the next one I say we should look for the carrying amount of the new factory. So we have to look for that one too. Carrying amount of the new factory. It's the same as we calculating for the cost of the qualifying asset, which will be the loan you used, the loan value you used for the qualifying asset plus the borrowing cost, the total borrowing
Um,
cost to capitalize.
Please, the answer for the total borrowing cost.
Is it wrong?
Yes, it's 52,660.
660. How do you get 600? Oh, okay. Yeah, it's 160. Eh?
Yes, please.
Okay. Yeah, so I think the mistake is from me. So I did a 50 over here. So that will be 660.
Okay.
Okay. So let's continue. So the total loan used. We need to calculate for the total loan used. What's the total loan used? We'll add all these together. This will give us the total loan used. So someone should add everything to for us. So add all this. Hmm.
1,200,000.
1,200,000. This someone should confirm for us.
1,200,000.
Okay. So 1,200,000 plus the borrowing cost, which is the 62,660. That will give us
1,262,660.
1,262,660. Okay, we are done. Any question? So these are the two main answers we needed. Any question on this? Okay, then let's go to our last question for the day. Then we'll do a little theory and then we'll end. So question three. Can someone read for us? Question three.
The Ministry of Roads and Highways decided to construct a tunnel that will link two sides of the village that were separated by the spillage of the Akosomo Dam in 2023. The tunnel would take 2 years to build, and the total capital outlay needed for the construction would be not less than 200 million Ghana cedis. The ministry borrowed 220 million from three sources and used the extra 20 million for routine road maintenance. Financing was arranged as follows: bank term loans, 50 million at 7% per annum; institutional borrowings, 70 million at 8% per annum; corporate bonds, 100 million at 9% per annum. In the first phase of the construction of the tunnel, the ministry placed some of the borrowed funds in a temporary investment for a period of 6 months. Income from the investment was 500,000, 5 million, sorry, required. Show how the Ministry of Roads and Highways will account for its borrowing costs in accordance with Ipsas 5 under each of the following policy options: A. Benchmark treatment option; B. Alternative treatment option.
Okay. So here they asked for the two approaches. So remember with the benchmark, we said with the benchmark, all the borrowing cost, whether it relates to the qualifying asset or not, you have to what? Expense it. So all the borrowing cost, whether it relates to the qualifying asset or not, you do what? You expense it. So let's do that for the A. So question 3A, that will be the benchmark approach. So treatment method or option. So yeah, we'll calculate for the borrowing costs. So let's calculate for that. We'll pick each of the loan facility and then we multiply the percentage by it. Right? Yeah, that's what we do. So the first one will be 50 million times 7%. Next one, 70 million times 8%. Next, 100 million times 9%. So let's do that. The first one will be 50 million times the percentage was 7%. Then we bring our answer here.
3,500. Thousand.
So 3,500
500,000.
thousand. Wait, 3,500,000. Am I right?
Yes, please.
3,500,000.
Okay. Then the second one will be 7 million on 8%. 70
550,000.
million rather.
Okay.
70 million on 8%. Yeah.
5,600,000.
5,600,000. And the last one will be 100 million times 9%. So 100 million times 9%. That will be
9 million.
9 million.
9 million. We'll add it together. So this plus this.
18,100,000.
Okay. 80,100,000. So that will
Yes,
be
please.
the answer for the benchmark. See, the benchmark is very simple.
Yes.
This for the benchmark. Benchmark everything you expense. So just let me just write here that borrowing cost to expense. Okay. Then we come to question the 3B. So question 3B. Now we are using the alternative treatment approach or method or option. So with the alternative treatment option, remember that one is where we have specific borrowing and general borrowing. So my question to the class, the loans facilities we have, are they specific or general, and you add why. Is it specific or general, and then why? Mm-hmm.
Um, it's specific.
Why is it specific? Why is it specific? Okay, anyone to help? Or what do you think? Is it specific or general?
Okay, so if it is going to be specific, maybe success because of the income from the investment was 500,000.
Eh, so that's your justification. No, 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 no. We have seen that a question can have both, so you can't just base on that.
Um,
Yeah.
okay, success. I think maybe it's going to be both because the specific aspect will be the 200,000 and 200 million. Then the extra 20 million for the routine road maintenance is the general one.
Okay. Okay. Any other?
Yeah.
Any other before I conclude?
That's the question.
Okay. The conclusion of the matter is that it is specific borrowing.
Thank you.
So why? So what is specific borrowing again? You borrowed it specifically for the qualifying
Construct.
assets.
Okay.
You borrowed it
So what about the extra 20 million? What are they
Yeah,
using it for?
I'm coming there. I'm coming there. Relax, relax. Calm down. Yeah, calm down, Kaka. Relax.
Okay.
So the extra is telling you that although you went for a loan facility, okay, let me start with why is it specific? Let me take my time. Why is it specific? So yeah, this statement said the ministry borrowed 220 million from from three sources and used the extra 20 million for the routine road maintenance. So number one is that they used the 200 million, which was what was stated in the previous one. They said the tunnel would take 2 years to build, which is the period, and the total capital outlay, meaning the investment amount or the amount needed for the construction, will not be less than 200 million. That means that the amount of money will be 200 million, the maximum you require for the construction of the tunnel is
General,
200
yeah.
million. And then yeah, they went on to say that you borrowed 220, meaning in excess of the
2
amount of the
million. 20
qualifying
million.
asset. Yeah, and the amount was from three sources. And you used it, and you used the extra 20 million for the routine road maintenance. So yeah, all the amounts you have here, they are general borrowing. But bear in mind that the general borrowing is only a portion that relates to the qualifying asset. Not all of them relates to it. Which portion relates to the qualifying asset? Is just the 200 million. The extra 20 million is for a normal expense, a maintenance expense. So that does not relate to the qualifying asset. Are you okay? Why is specific? I've added the two. Why is specific? And then the 200 million for the qualifying asset and then the extra 20 million. What it means? Are you okay with that? Now let's confirm the amount. The first loan was 50 million. Second is 20, and the last one is 100 million. Let's add these loans together. When you add the whole, what do you get?
220 million.
220. So that's telling you
Yes,
that
please.
that's the total amount we went to borrow for the qualifying assets. So you see, it's totaling up for your 220. So yeah, this question is specific borrowing. It's specific borrowing. So if you come here, how do we get the borrowing cost over here? Using the alternative treatment approach or method. How do we get it? We say specific borrowing is the formula is what?
Actual borrowing
minus
So the actual
investment
borrowing
income.
cost.
income from investment.
Okay. So it will be the actual borrowing cost minus income from investment. So we bring the actual borrowing cost. How do we get the actual borrowing cost? Yeah, the actual borrowing cost is should be devoid of the one that relates to the routine road maintenance. So bear in
Okay.
mind the total borrowing cost. You have already done the calculation here, so I don't want to recalculate again. It's 18.1 million. Ten times multiply is what again? Kindly mute yourself. Okay, so as I was saying, the borrowing cost you have already calculated the total. The total here is 18,100. Now bear in mind that this 18,100, we need to eliminate the portion that relates to the road maintenance. And how are you going to do this? So let me just bring the total. The total here was the 18,100. And then we have to look at the maintenance, the one that relates only to the maintenance. How do we do that? We just apply normal ratio and proportion. So in applying ratio and proportion, it will just be the maintenance amount. The loan amount was for the maintenance was what? 20, right? It was 20, right? For the
20.
maintenance. So we'll take the
20.
20,
Yes, please.
then we divide by the total loan. So we know that the total loan facility is what? 220, right? 220. Then we multiply by the 18,100.
Mm.
So let's do that. What will you get? What will you get?
164
One,
64
one,
5455
6, 4,
5454
5, 4, 5, 4.
.5.
0.5 again. Can someone confirm?
Are we doing it one decimal, please?
Yes, sir. Yes, sir.
Um, okay, let's do it this way. Let me just work with millions so that it will be easier for everyone. So it's 18.1 million, right?
Yes, please.
Yes.
So let me work with that. Let me bring them. Ghana cedis. So let's calculate this again. What do we get?
$1 million.
So just ignore the zeros and let's do it this way. 18.1 million. What will you get?
You're supposed to get 1
1.6.
1645.
So 1.6545.
45.
So run it
Yeah,
up to
please.
decimal place.
It's fine.
65. So bear in mind we will subtract this from the total to get the actual borrowing costing here. So you're looking for this actual borrowing costing. So to get the actual borrowing costing here, less the one for the maintenance. We just do ratio and proportion to get the maintenance portion. Then we subtract from the total. So when you do that, what do you get?
We are getting 16.45.
16.45.
16.45.
45.
Then we'll less the investment income. So let's less the investment income. The amount for the investment income was 5 million. So we have carried a million.
Yes,
Let's bring. So it is 5 over here. So when we subtract 5 from this, what do we get?
11.45.
11.45.
11.45. So this will be the borrowing cost to capitalize. Borrowing cost to capitalize. What about the borrowing cost to expense? Who can tell me the borrowing cost to expense? What's the borrowing cost to expense? Mm-hmm. It is 1.65. I hope you know why. The total borrowing cost in this question was 18.1. But out of this 18.1, it's only 16.45 that relates to the qualifying asset, meaning that the remainder 1.65 is what? Borrowing cost to expense. So when we go to your statement of financial performance in public sector, that's how I call it. You are going to record 1.65 as the borrowing cost to expense. Okay, let me see. Did the question ask us to calculate for the okay, they only said we should account for the borrowing cost, but let's add it to it. Let's look for the cost of the qualifying asset. What will be the cost of the qualifying asset? So the cost of the qualifying asset, you already know the formula, specific borrowing amount plus the borrowing cost to capitalize. So the cost here will be the specific borrowing amount. And what's the specific borrowing amount here? What's the specific borrowing amount here? And the question, what's the specific borrowing amount?
Uh, how is it 200,000?
Yes, it's going to 200,000. So it's
100
200,000.
million,
Then
sorry.
200
200
million,
million.
yeah. It's going to be the 200 million, not the 220 million. Why is it not the 220 million? 20 million out of the 220 relates to the road maintenance, which is an expense. So
Yes.
it's really the 200,000
Yes.
that relates to the qualifying assets, which we are going to consider. So we'll add the borrowing cost to expense, which is 1.65 million. So that will give us 201.65. Right. So that's that. Are you okay with this? Are you okay with this question?
Oh,
Hello?
that's it.
Yeah, is there a question?
The formula says that specific borrowing amount plus borrowing cost to be capitalized.
Yeah.
But here you are
What did I
using borrowing
use? Oh, okay. Sorry.
to be
It was an oversight. So yeah, it's 4-5 rather. Okay, 11. So that will give us 2-1-1. That was an oversight. Thank you for the correction. Any other question? Yeah, hands up. Go ahead.
Yeah, I would just want to ask, what's the difference, how is it different from the general IFRS? How is this one, the borrowing cost under the Ipsas, different from the one under the IFRS?
Okay.
30,
Thank you very
23.
much. So at the beginning, I said that with public sector accounting, with the borrowing cost over here, we have two approaches. It's the benchmark approach and then the alternative treatment approach. But with FR, they don't have the classification as benchmark and alternative treatment. They will do everything that we did under the alternative. That's what is done under FR. They don't have anything like benchmark. So that one, they don't give you an option to choose between benchmark and an alternative treatment. They don't give you that option. They use the alternative, but they don't call it alternative in the IFRS. As they just over there, that's how they calculate for their borrowing costs. They have specific and general. Then you just go. But with public sector accounting, you should know that we have benchmark and then we have what? The general. Then we have the benchmark and then we have the alternative treatment. Are you okay?
Yes. Very well.
Okay. Any other question? Okay, so we have some few theory here. Some few theory here. So the theory here is for you to know under the alternative treatment, you need to know when to start capitalizing the borrowing cost, when to suspend, and when to cease. So these are some additional theories you need for in case they ask you some theories under the Ipsas. So when do you commence capitalization? We say you commence capitalization when these four conditions prevail. That's number one, borrowing cost is being incurred. Borrowing cost is being incurred is when you go for the loan, the cost on that loan, when you start incurring those costs on the loan, then we say borrowing cost is being incurred. The next one is when the qualifying asset is not ready for its intended use. Bear in mind, borrowing costs, you start incurring borrowing costs when you go for the loan to use for the qualifying asset. So meaning that time the qualifying asset will not be ready for its intended use. And then the last one, expenditure for the qualifying asset is being incurred, which implies that you should start incurring some costs relating to the qualifying asset. So in the case you want to build your dreamland, you should start incurring costs associated with you building your dreamland, your dream house, sorry. Then the last one, activities to get the qualifying ready are ongoing. So any activities involved in getting your qualifying assets ready, they are they are in progress. They are in progress. So these are the four conditions you need to know under commencement. What about suspension? What's the meaning of suspension? Suspension here means that you pause the capitalization for a period. So when do you suspend capitalization? We just have two. We just have two. So there is a suspension of activity to get the qualifying asset ready for its intended use, unless the suspension is only temporary. So that's the first one, whereby you have a suspension of your activities. And the reason why you are suspending your activities is to get the qualifying asset ready. But they add that unless the suspension is only temporal, there may be an instance the suspension may be temporal, which may not be considered. But in the case whereby the suspension occurs, then you should consider that. Then the next one is that the expenditure is not being incurred on a qualifying asset. So maybe during that period, you are not incurring expenditure for a particular qualifying asset. So this is something a little different from FR. And then the last one, when do you cease capitalization? So where the alternative treatment is selected, you cease capitalization when the asset is completed and available for its intended use. When it's completed and available for its intended use. So we have a question here on the date, just to know if you understand what we have been doing so far on the date. Should I allow you guys to try, or we should try it here? Okay, let's try. Let's try. So this will be our last question for the day. So reader, can you read for us?
On 1st January 2018, MMDA obtained planning permission to build a new office building. Construction commenced on 1st March 2018. To help fund the cost of this building, a loan for 5 million was taken out from the bank on 1st April 2018. The interest rate on the loan was 10% per annum. Construction of the building was suspended during the month of July due to a strike action. The building was substantially completed on 1st December 2018, and the total cost incurred on the building as 31st December 2018 was 12 million. Required. Aye. Assuming
We are
MMD
getting
adapts
feedback. We are
the
getting feedback from
alternative
someone.
treatment of
Oh, relax, relax. We are getting feedback from someone. So please, the others, if you're not reading, please mute yourself. Okay, reader, continue. You are still getting feedback.
Okay, I'm reading.
You proceed.
I'm taking it from the interest rate on the loan was 10% per annum. Construction of the building was suspended during the month of July due to a strike action. The building was substantially completed on 31st December 2018, and total cost incurred on the building as at 31st December was 2018 were 12 million required, assuming MMDA adapts the alternative treatment of borrowing costs. A. When should capitalization commence? B. What is the period of capitalization? C. What is the carrying value of the office building to be included in PPE at 31st of December 2018?
Okay, thank you very much.
This is the
So yeah, when should capitalization commence? When should capitalization commence? So remember the conditions for capitalization. Yeah, we said these four things. When they prevail, then capitalization will commence. So borrowing cost is being incurred. Qualifying asset is it's not ready for yet its intended use. The expenditure is being incurred, and activities to get the qualifying assets are ongoing. Okay, so let's check for each one. The main one will be the borrowing cost is being incurred. When is borrowing cost being incurred? The day you go for the loan, that's when the borrowing cost will be incurred. So what is the date that you went for the loan?
1st April.
So 1st April 2018. So on 1st April, so borrowing costs being incurred then. Let me do it that way. That's 1st April. April is 4. Then we come to the qualifying asset is not yet ready for its intended use. Definitely in this question, it's not yet ready. Next one is expenditure is being incurred on the qualifying asset. So check which expenditures are being incurred on the qualifying asset so far. Mm-hmm.
during the month of July. So there was a strike action.
Are you sure? I said which activities did we incur for the qualifying access in the question? So number one is the planning permission.
Oh,
So the
okay. I didn't know that.
so the planning permission is one. So the date for the planning permission is first which date? First January 2018.
January, yeah.
So that's January 1. First January 2018. Also another one is when construction commenced. But we can see the activity space it started on 1st January. So that one will override the one that occurred on 1st March. Okay. Then the next one is activities to get the qualifying access ready are ongoing. So yeah, definitely we're told the activities are ongoing. The planning permissions and then the rest, they are all ongoing. The construction and all those things are all ongoing. So we have these two dates. The planning permission. Someone can even add the construction too, if you want to, when you started the construction.
Yes, because it was spotted.
So which is first March. First March. Okay. So these are the dates that we have. So when do you think we are going to commence capitalization? Yeah, go ahead.
I said first.
Uh-huh.
I said first April.
You said July. You said July.
Are you
Fine.
sure? I was like, they told us they took the loan.
I don't get you.
So
Let
I
me
was
come and
like,
question.
commencement for finishing capitalization will start from the day that they took the loan.
The day they took the loan. And that's one of the conditions.
I was saying it will start from April, from that part, and it will end at July.
Abi, that's what I've put in.
Oh, okay.
Please mute yourself. There are lots of feedback. Okay. So let's proceed. The next one is what is the period of capitalization? What is the period of capitalization? So remember I said period. Oh, period of capitalization. From when to when?
It will
So
be
now
from first January to
we have identified the starting. Let's identify the ending date. We have identified the starting. Let's identify the ending. What will be the end?
31st December 2018.
31st December 2018. Are you sure? Yeah, you're right. You're right. Partly right. Let me put it that way. So the period here will be from first. So the first time we started from 1st April till when there was a suspension. Remember there was a suspension. They said the month suspended during the month of what? July due to a strike
July.
action. due to a strike action. So means July is not part, right?
Yes,
So
please.
this period will be from 1st April to which date? 1st April to which date?
June.
To 30th June.
June 30th.
30th June. That will be the first one. And it will continue
Yeah.
after July. After July will
After
be
July. So
August.
so
July,
1st
August,
August.
first August.
Yeah, first August. So the ending,
31st
The end of August.
December.
31st. In the question, was it December?
Yes,
Okay,
please.
December.
Yeah.
December. So if you are taking the number of months, what will be the month for the first one?
3 months.
3 months. And the second one will be
5 months.
5 months. So total period will be 8 months.
8.
8 months.
Okay. So that's the total period, 8 months. Then we come to the C. The C is asking us what's the current amount of the assets of the office building to be included in PP at 31st December 2018. This one is look and tell, Anna.
Yes, so
Yeah, so what's the amount?
12 times 10%.
Hey, why are you doing 12 times? Where is the times coming from?
We are trying for a carrying amount.
Okay.
So anything 12 million.
Like 12 million times.
But then depreciation will come in.
Okay, so remember, first things first. Is this specific borrowing or general borrowing?
Specific.
Why?
Because MMDA obtained the planning permission to build a specific asset, which is an office building.
Yeah, so that's right. So it was to build a specific. So that's specific borrowing. So how do we get the borrowing cost? That's the first thing you do. So A, yeah, this was the A. Let me bring it here. So the commencement date was 1st April. That was when all the conditions was met. And this was for the period. So we move on to the C. So yeah, we first have to look for the borrowing cost to capitalize. So borrowing cost to capitalize here will be capitalization and the rate over here, which is 10%, multiplied by the loan value. So that's where some of you had it wrong. You multiply it by the loan value, which is what? 5 million. So yeah, you multiply by 5 million. Then we'll consider the period involved. When did we commence capitalization? 1st April. But we suspended for a period. So the total period we had identified was what? 8 months. So yeah, it's going to be 8 over 12. So that will give us
33 million. Hey, 333 million.
300.
330.
Mm.
Okay, this is your figure, are you sure?
Yes, correct.
Are
You're
you
not
sure?
you're not mentioning it all.
Yeah.
So check 10%. Let's just we are leaving our answers in millions. So 10% on 5 times 8 over 12 It should be lesser, if I'm not wrong. You should get a lesser figure.
So we are getting
333 million,
333,000.
333,000.
300 and
It's supposed to be 333,333.33.
okay, so
No,
maybe so 300
doing it in millions.
so
We have
300 and
6,
So 300,
uh-huh.
333,333.33 cities.
Okay. So 0.33 like there.
Point 33.
Okay. So now let's look for the
Yes.
carrying amount. Carrying amount. Which would be the cost incurred on the assets. And we're giving the cost incurred on the asset to be what 12 million here. So 12 million plus the borrowing cost to capitalize. This is a 333.33. So that will give us 12 million 333 333.33, right?
Yes.
So that's all.
So success.
Yes,
So,
please.
so sometimes the cost of the building or the asset can be more than the loan itself. In this
Of course.
case.
Of course. That could mean that you finance some from your own pocket. And
Okay.
then the rest you took a loan to support the rest. So yeah, it's possible. Okay. So
Okay.
lastly,
Thank you,
these
sir.
are some disclosure requirements in the standards. There are more than these, but these are just yes, please. It appears someone has a question. Who is talking? I think your network is not helping you. Your network is not helping you. Okay, let's proceed.
Success.
Yeah,
Move on.
I think it's better now. We'll move on. Ask your question then. Okay, let's proceed then. So these are some disclosure requirements. The accounting policy adopted for borrowing cost, you should disclose it. The policy are using the alternative method or are using a benchmark. You should disclose that the amount of borrowing cost you capitalize and then the capitalization rate you used. Basically, when it relates to general borrowing, the capitalization rate, how did you get it? These are some things you need to disclose. There are others as well. When you check the full standard, these are just some few. Was so we'll end the discussion here. If there is any question, you can let me know before I exit. You have 10 minutes to go. So is there a question? Yeah, hand is up. Go ahead.
It's a mistake.
Okay, it's a mistake. Okay, no problem. Okay, so the next meeting will be on FR and CR for the FR and CR people. And then if you check, we have updated the timetable. So it's going to be on Saturday. So Saturday we'll be having two sessions. One in the morning for FR and CR, and then one in the late afternoon around 3. So that will be all for now.